Well, good evening, ladies and gentlemen. How are you on this fine, fine Wednesday evening? I hope that all of you are doing absolutely stunning wherever you are spread around this world. And I want to welcome you all tonight. Welcome Ron and Mark and Kate and Stacy. I think I got all my moderators mentioned there. And we're all thrilled to be with you guys tonight. So tonight we are getting into Level 2 of Foundations of Stocks and Options, Class 2. It's Class 2, Level 2, or Level 2, Class 2, however you choose to say it. And tonight the discussion is what we are simply calling the trend. And here's our agenda for the day as we take a look at what's coming up. We're going to talk about the psychology of the trend and what makes a trend happen from a psychological standpoint. We're going to talk about types of trends. We're going to get into identifying trends, trend reversals, and I mentioned volume implications, and then I actually decided not to put that in there, and I just realized while I am reading my slide that I left that on the overview here. Really, volume implication is super simple. It's so simple that I decided to leave it off. It's basically when you have a breakout, we have increased volume. That's really the essence of it. So now that I left it in my overview, I feel like I have to share it with you. That's really all there was to it. So anyway, that's our agenda for the day. I ended up with almost 50 slides, so I decided to take that volume stuff out at the end. If we have some time at the end, we'll go over to Trade Navigator, and I'll just show you some of the implications of how volume plays out. It's pretty obvious. All right, let's go ahead and jump on in here to the details of it, the psychology of the trend. And as we talk about the psychology of the trend, you guys hear me talk about it all the time. You hear me say that the technical trader is really dealing with the emotions and the sentiment of the trader and what's going on from an emotional standpoint, what we call trader sentiment. Okay, so you can really sum all that up into psychology or emotion. Whenever I talk about the psychology of a trend, understand that word or that phrase should not be confused with trader psychology, which would be the psychology of the individual trader and being a successful psychology, or being successful from a psychological standpoint. So sometimes that can actually be a little bit confused. This is not a psychology class tonight, but rather this is more of a theory class on why trends behave the way they do. Yet it is a psychological issue because, as you know, as a technical trader, what Charles Dow discovered and what we have discovered in the world of technicians is the trend and everything associated with price action ultimately comes down to the sentiment or the emotional makeup of the group or the herd of traders. So as a quick review and just kind of tying this in to what we discussed in the last class. The last class we talked about the basis for technical trading, and we discussed Dow theory in great detail. And a lot of you guys had some major ahas last class. These were the 6 tenets of Dow theory as we talked about them in the last class. Price discounts everything is the first foundational principle of Dow theory. There are 3 levels to the trend. Those 3 levels, of course, being the primary, the intermediate, and the minor level of the trend. Trends have 3 phases: the accumulation, public participation, and distribution phases. Averages must confirm each other, and those averages being the Dow Jones Industrial and the Dow Transports. And volume must confirm the trend. So that is, in essence, that volume goes with the trend or the momentum of the trend. And then the final tenet is, I summed it up a little bit differently tonight. I said a trend in motion stays in motion. The way that Charles Dow said it is a trend is assumed to be in effect, or it's assumed to still be trending until it's given definite signals of reversal. But I actually like summing it up, saying a trend in motion tends to stay in motion. Okay, so those are the 6 tenets of Dow theory as we discussed in the last class. Now, also as we discussed, and hopefully I brought you to an understanding, Charles Dow discovered several principles of the stock market that most people had mostly ignored up until his time period. Number 1 being that markets are driven by factors beyond the fundamental data alone. We spent a lot of time talking about this in the last class as we discussed the differences in fundamental and technical data. So markets are driven by factors beyond fundamental data alone. Also discovered that human emotion, the thing that we refer to as sentiment, is the real driving factors that fundamentals cannot measure. And that's the sad part for the fundamental analysts. Nothing wrong in particular with fundamental traders. I don't have any disdain for them. But the problem with the fundamental trader who ignores technicals is they ignore the only measure of human sentiment that we can measure, and that is actually the price action of the stock. The price action of the stock is always going to reflect the human sentiment, and that's the only way to see it. You can't see that by looking at the statistics about the company. Interesting thing about human behavior is people tend to herd. And whenever I say people tend to herd, what I mean they tend to follow the crowd. And it doesn't really matter who you are or what you think about life. You tend to be part of the herd. Very few people truly march to a different drum and do that with great success. You know, I mean, if you see this all over the place. A certain type of a movie is trending nicely in the movie theaters. What happens? Well, I heard this movie was great. Let's go see it. Why? Because the public sentiment about that movie was going higher. It was bullish sentiment about the movie, right? People believed that this movie was going to be good. And so the public ends up following and doing the same thing. If you hear, good example of that, the movie The Titanic, biggest movie, and well, at the time it opened, it was the biggest movie in opening history. And you know, how many people really cared about seeing a sad story about a boat sinking? Not a whole lot of people really cared about it, but all the hype leading up to the opening weekend said this was going to be a life-changing movie and everybody should go see it. So what happened? The herd said, oh, yeah, let's go do this. And as one person said, yeah, I think I'll go see it, friends start talking about it, and then Billy realizes that Janet's going to go see it, and, Billy kind of has a crush on little Janet and says, well, I think I'm going to go see it too. And then before you know it, the whole theater is packed out because the crowd went to go see it. In other words, we might call it peer pressure. But peer pressure in and of itself is whenever you have your peers that are pressuring you to do something. Herd mentality is almost a subconscious reality when the herd says, yeah, this isn't working, let's shift. In fact, this really gets into an interesting study, a study of socionomics, that is how society behaves. And for people who really get into that study, it's a bit of a nerdy study, so I don't spend a whole lot of time reading the materials on it. But the interesting thing about socionomics is you can really study herd behavior on just about any aspect where public sentiment can be involved. For example, would you guys believe it if I told you that presidential elections are persuaded by a herd mentality? From a conscious or a subconscious standpoint, the majority of the people start to sway one way or the other, and it generally, at this point in history, tends to go by the party more so than even with the candidate. And so in the last election, the Democratic Party had a little bit better public sentiment, mostly because of the disdain towards the Republican Party. And this coming election that we're going to have this fall, if the president does not get reelected, it will probably be because of the exact opposite. There's a little bit more disdain for the Democratic Party than there is the Republican Party. I'm convinced that neither party is really liked in Washington. I don't think anybody really likes Republicans or Democrats, but we have a disdain factor for one party, and that becomes part of the herd mentality. And as you get more and more people that dislike something, the herd tends to sway in one way or the other, and you kind of almost end up with this little tipping point. Well, that little tipping point, it permeates all sorts of stuff in society, everything from presidential elections to stock prices to the types of movies. In the study of socionomics has actually studied trends for the various types of movies that will be popular during a time period, whether it be a horror flicks or whether it be romantic comedies. And then during those time periods, you actually see an interesting spike in those types of movies. It's really quite fascinating. Anyway, bottom line is people tend to herd, people tend to do what other people do, and that's just the nature of it. And so as a trader, what we want to do is we want to identify those trends and we want to trade them successfully. And once a sentiment changes, it tends to continue in that direction for at least a while, if not for a major long while. All right, so let's ask this question. Why do trends form? And specifically in the world of trends tonight, we're going to talk about why do trends form in the stock market. Really, the truth is it's a herd mentality and it's a change in sentiment. You can apply that to anything that relates to human behavior. But tonight we're going to discuss it as it relates to the stock market. Why do trends form? And the answer is it's basic economics. Now, in the last class, I proposed to you that prices move because public opinion or the way people perceive a stock would change suddenly. That's what I proposed to you in the last class, and that is true. But the actual function of why a trend changes really does come down to basic economics, and those basic economic ideas are what you guys are all familiar with. We call it supply and demand. As we look at supply in the stock market, what would qualify as supply? Well, supply is the amount that is available. Well, this is an interesting issue because whenever you look at a stock, let's say that a stock has, we'll just make up a number, it has 10 million shares that have been issued. Okay, so if you have outstanding 10 million shares outstanding, that is a limited supply. One would say, well, how can you increase the supply if there's 10 million shares that are outstanding? And the answer is you really cannot increase that portion of the supply, can you? But which portion of the supply could you increase? And the answer is the portion that can increase are the amount of shares that are up for sale. You may have a limited number of outstanding shares, but those shares may not be available because obviously people have already purchased them. So the supply in the world of the stock market is increased by those market participants who are willing to sell and who are anxious to sell. And as you get more and more anxious sellers with a particular issue, whatever that stock may be, whether it's Apple or Amazon or Baidu or any other stock in the market, as you get more and more people that are anxious to sell, we have an increase in supply, meaning we've got more and more people anxious to sell. They're competing with each other. They start to drive the price down because they're saying, oh, well, I'm ready to sell. You know, we're selling at $100. You're not willing to buy it at $100. Well, what about 98? I'll sell it at 98. And so they're competing with their other suppliers, the other sellers, dropping the price. Consequently, what happens is the price starts to come down. That selling pressure builds and it starts to drive it down. Okay, now the opposite is true in the case of stock market demand. What's happening whenever we have a high demand period? Well, that means there's a lot of people that are saying, hey, I really want to buy this stock. And so they go out and they say, well, I'll bid it up a little bit here. You know, it was $100. Well, I'm willing to pay $105. I just need some shares. Give me some shares. Give me some shares. And so the demand aspect of trends happens whenever there's more buying pressure than there is selling pressure. And as that buying pressure is building and the selling pressure is building in the case of supply, but as the buying pressure is building in the case of demand, the price starts to rise. And in the middle is a person that we refer to as the market maker. Now, the market maker has an interesting job. The market maker's function is to literally make the market. So the market maker is sitting here saying, oh, gosh, I've got 2,000 people that want to buy, and I only have 500 people that want to sell. What am I going to do? Well, the market maker has got to do what? To increase the selling, the attractiveness for sellers in the market. The market maker is going to raise the price. If you got 2,000 people that want to buy, 500 people that want to sell, you've got to make it more attractive to sell. So the market maker is actually going to raise what we call the bid. They're going to raise the bid price, attracting more sellers into the market. So maybe one person says, well, I'm not willing to sell at 100, but gosh, you raise the price to 105. Yeah, I'll sell there. And that's what the market maker does. So the market maker is moving the market literally because that's their job. Their job is to move it, to make the market, to match the buyers and sellers. One of the biggest misstatements on Wall Street is whenever you hear the news report that there were more buyers than sellers on Wall Street today. Or when you hear the news report there was more sellers than buyers. That's physically impossible. In order for the transaction to take place, you must have both a buyer and a seller. Now, in order to make that happen, the market maker has to go literally make that market. Consequently, when the transaction occurs, there is a balance for at least a brief moment in time, an agreement of the price of that stock. You've made the deal, you reached the deal, the market maker structured the deal, put it together, and we've come to an agreement at least for a snapshot in time. Then, of course, the bid and the ask continue, and the whole game continues. This is the basic economics of how a stock works and how stock pricing works. Now, what does that have to do with trends? Well, the trend idea is going to be the combination of the herd mentality mixed with this basic economic principle of supply and demand. Okay, so let's come over here and let's take a look at a stock. And let's say that you're looking at this trade And maybe the buyers have really driven the stock up. And as we get up here, the sellers have a specific psychology, a specific thought process that goes through their mind. Let me just ask you guys. Let me assume for a moment that some of you guys purchased down here at $190 a share. And over the course of 3 weeks, the stock has run up to $240 a share. How many of you are thinking after about 2 weeks, dang, this thing just ran up $50 a share. I think I would like to sell. Go ahead. How many of you think it's time to sell? So I got a lot of you writing in here. Yes, sell, sell, sell. Not a lot of you are thinking I'm going to double down at $250 a share. Granted, I've trained most of you, so that's why you're not thinking that, right? Yeah, so the answer is yeah. Why are you thinking that? You're thinking it because you got $50 a share in 2.5 weeks, and you're thinking, golly, I'm happy with $50 a share. It's a great profit. Well, you're not the only person. What happens is the majority of sellers come in with this idea that, dang, the stock's a little too high. I want to start taking my profits. I mean, it was just 2.5 weeks ago. I thought this was a great deal at 190, and I bought it at 190. And before I know it, 2.5 weeks later, the stock has run up to $250 a share, and I think I better sell this thing. Now, there's also an underlying emotion. How many of you have ever experienced this? Hopefully you have, because it's a good emotion, actually. When the stock runs up, you've got all this profit, and you start to have a fear. And you say, my goodness, it was a great trade, but now I'm afraid that my money is going to disappear. I'm afraid that all this profit is going to go flying out the window. I'm afraid it's going to sell off super, super fast right out from underneath me. And so what happens is you start a selling process. How many of you can identify with this psychology? How many of you can say, yeah, I've jumped into a stock, or I can see why you would jump into a stock at 190, 2.5 weeks later, I'm up $50. Yeah, gosh, it's time to sell. I'm a little afraid. I'm afraid it's going to sell off quickly. I want to take my profit. And so for fundamental reasons, maybe for emotional reasons, maybe it really doesn't matter what your personal logic is to it. The idea is that you decide to start selling. And that selling starts to pile up. Okay, now, if you and about, we'll say a few million other people decide that it's time to start selling these shares, what's the market maker got to do? Market maker has to start dropping the price. Why is the market maker dropping the price? Because the market maker has to start dropping the price to find buyers. Because realize during this price period, this sequence right through here where I just marked, there was a lot of buying pressure. There was a lot of buyers that were saying, yeah, I'll keep bidding this thing all the way up there. I'll pay 210, pay 220, I'll pay 230. Then we get to 240 and the sentiment suddenly changes. Well, I was willing to pay 210, but 240? Well, gosh, I'm not going to pay 240. And then, of course, there's also the herd that starts to tip over there. I saw someone mention in here Malcolm Gladwell's The Tipping Point. Yeah, that's the same idea. The herd starts to tip over, and the herd says, well, yeah, that's a little too high. I think I'm going to sell. So you've got a combination. You've got buyers that are not willing to pay as much, and you've got sellers that are saying, well, gosh, now that you're selling for 240, I'll sell there. I didn't want to sell at 210. I didn't want to sell at 230, but 240, yeah, I'm happy to sell at 240. And so the selling pressure starts to come in, and as the selling pressure starts to come in very rapidly, what happens? Boom, we have an immediate sell-off. Well, that freaks everybody out. We have an immediate rebound as the buyers say, oh, the same buyers that bought at 220 over here, they thought, oh, 220 again 3 days later. Yeah, that's great. I'll buy some more. But it's not enough. The selling route or the selling frenzy ensues, and it sells us off until we come back down here to about $210 a share. Now, here's the interesting thing. There is a bunch of people at this point that are feeling one common emotion. What is that common emotion? Any idea? There's a bunch of people. Let me be more specific of who those people are, because you guys are so smart, you're thinking both sides. There are a bunch of people who bought here at 180 or 190, rode it all the way up to 240, and they rode it all the way back down to 210, and they are thinking what? Oh no, if only I could get back to 240. So there's two sentiments that are going on here. There's two psychological elements. There are investors who say, I jumped in early, I rode it all the way up, and I held it all the way back down. If only I could get this thing back up. Let me draw my crazy goo-goo-eyed man again. If only I get this thing back up, I will sell next time. There's also another pool of fish here. Who's the other pool of traders? It's the people who said, my gosh, just 2 weeks ago, this thing was at 240. It's down to 210. I think it's going to keep going higher and higher. That is the sentiment that creates this long lower shadow on the candle. And it's the sentiment that suddenly creates a buying frenzy in roughly the same location. And the buyers drive the market back up. Before you know it, a week and a half later, we're back at 240. Now, what happens as soon as the stock returns to its high? What happens? Those investors who did not get out 2 weeks before are suddenly saying, get me out of here. I saw it at 240. Let's get out of here. And immediately the selling frenzy resumes. And so the panic, I called it a frenzy. I should have said selling panic. The panic resumes and the selling pressure comes in. And now, before you know it, you have a full-blown bearish trend that has turned around. How many of you understand the psychology now of why selling pressure works? Ken says, ooh, big aha moment. Good for you, Ken. All right, now let's turn this thing around. Once we get back down here to 180, those same traders and those same investors are thinking different things now. What are they thinking? Well, gosh, it was only a couple of months ago that this stock was at 240. It doesn't matter that we just sold off rapidly. They're kind of done with that. They say, man, this thing was just at 240. I think this is a really good deal. I said 240, 250. You guys see the chart. It's in that general range, right? All right, so, wow, it's a $180 stock, but it was just $240, $250 a couple of months ago. This is a really good deal. So a couple of things start to happen that create buying pressure. One form of buying pressure comes in the form of short traders who are doing what? What are short traders doing suddenly when we get down to a really cheap price? Short traders are buying to cover. Thank you. You guys are so smart. So short traders start to cover their positions. In fact, usually, very, very often, these lower shadows on your candlesticks, they happen at the end of the day. That's almost always short sellers coming in at the end of the day to cover their positions. Same thing happens at the top. And so, you have these traders that will trade it all the way up. They'll watch it all day. They get in that last 45 minutes of the day and they say, okay, let's get out of these trades. And so you got a lot of short covering. Not all the time, but a lot of times that lower shadow is a short covering, or it's a plethora of short coverings. It's a lot of it, okay? So then market came back down. We start to get some buying pressure in here. We've got a form of buying pressure from short coverings. We also got a form of buying pressure from people who remember, hey, I bought it at 180 before. It worked well. I wrote it up to 240. Let's try this again. And so the early adopters, the people that we in the last class called the informed investors, the informed traders or the early adopters, they start to take some of their first positions. Traders who missed their chance. What about traders who thought whenever it was at 240, they were like, man, if this was only at 180 again, I would buy it next time. Sure, those people jump in as well. So the traders who missed their chance at 180 the last time, they're thinking, man, Amazon's a great company. It's got to be going back to 240 pretty soon here. They jump in back at 180, right where they had wished they had gotten in before. And before you know it, as soon as the stock returns back into its low territories, we have that buying pressure that resumes, and that buying pressure creates the foundation, it creates the support, it creates, in this case, an accumulation period, and eventually the bullish trend resumes. That is the cycle of the psychology of how trends get formed. This is pretty interesting stuff, isn't it? So here's the answer, pulling all of this together, and I'll again answer the question in a question. Why does supply and demand suddenly build up in these places? And the answer is what we've just talked about, the trader sentiment. The trader sentiment explains to people, or explains what's going on. It's a theoretical explanation, but it's a genuine explanation. It explains the psychology of what traders are thinking in those price points. Now, before I go any further, how many of you can identify, as I talk about the trader psychology and what's going on, how many of you believe that that sounds like you? You can see yourself being part of that herd at that price point. Can you guys see that? Frank says, I've been there, done that. A lot of you are agreeing. And you agree because it makes perfect sense. You say, yeah, that's exactly what I was thinking. If only I could get in here. If only I could get back in over there. And so it's whether it's conscious or subconscious, I don't know. But the idea is that people tend to go back and do historically the same things that they've done before. So the optimism, the sentiment justifies it. The trader optimism leads the traders to justify buying their positions or selling it. The fear leads the traders to justify selling their positions or buying to cover. And then, of course, the lack of confidence leads a trader to react with emotional decisions. Now, what do I mean with the lack of confidence? Traders are inherently insecure. It is natural. We're dealing with money. And individuals, for whatever reason, I know the reason, we've been programmed as a culture to believe that money's worth more than it is. And because we believe that money's worth more than it is, and most people have spent their entire life exchanging their hours, their most precious asset of time, they've spent their entire life exchanging their hours for money. Money has a very deep emotional connection to the average human being. So because there's such a deep emotional connection, whenever we have a fear of losing money, that emotion overcomes us. It's a logical, natural emotion. You don't have to be embarrassed if you've experienced that. We've all experienced it. So here's what happens to traders, especially if they're not 100% convinced of their trade. They get a lack of confidence, and their lack of confidence will lead them to change their trading plan on the fly. In other words, mid-trade, they don't really have a trading plan. Mid-trade, they say, oh, this looks like what's happening. That's what I'm going to go do. Or maybe they weren't even mid-trade yet. Maybe they thought, well, next time it gets to 180, I'll buy. But the stock kept running up 210, 220, and they thought, oh, it's at 220. I thought I'd buy at 180, but it's at 220. I better buy. Before you know it, they bought in at 239, and the stock turned down because they were too late to the party. So in other words, the lack of confidence, second guessing, lack of having a good trading plan, it all leads a trader to react with emotional decisions rather than good, solid, analytical, logical decisions. How many of you can see how this would happen? And interestingly enough, all of it somehow ties together in the same price ranges. This is both the blessing and in some ways the mystery of the stock market. The mystery of support and resistance is how does it happen when in reality so few people really recognize support and resistance, and yet for many, many years, over 100 years, we can go back and study charts and see that this cycle has happened over and over again in the same price points back to back to back. It's almost a mystery. At the same time, it really is so structured that it really looks like it's a manipulated market. And I can't really explain how it happens, to be completely honest. All I know is that it happens. And knowing that it happens, it's something we can trade. So let's go a little bit deeper here and ask this question. When we trade this stock back up to the $240 range, who's selling? And the answer is everybody's selling. And it doesn't just mean that everyone is selling to close. We've got both sell to close orders and we've got sell short orders. All of it is happening in the same location. Because the traders that recognize that this is a good shorting opportunity, they're starting to load up on shorts. The traders that recognize that this was a good that this had been a good buying opportunity, they're looking to close out and to take their profits. Now, out of these two peaks right here, this one right here, and then this one right over here, which one, number one or number two, do you believe would have more shorting behavior? Which one would have more shorting? The answer is number two, exactly. Why? Because the traders that traded this up and sold to close, we'll put an STC, they sold to close, they took their profit. As it ran up again, what did they say? Dang, I wish I had more to sell. They didn't, so they enter a sell to open or a sell short order. And that sell short order becomes part of the selling frenzy that drives the stock down again. It's one of the reasons we get double tops. It's fascinating. Yet the psychology is exceptionally predictable. So everybody's selling, both the long traders who are selling their closing positions and the short traders. Who's buying? The people who were afraid to get into the trade. That's the only people that there are left to buy. The only people left to buy are the people that were afraid and they were coming in late. So since the majority of buyers were down here, what happens when we get up here? We have a lack of buyers. We have an imbalance of supply and demand. That's why there is one fundamental aspect that you can look at that will often tell you where the reversal is going to come that's very closely tied to the price action, and that is the amount of cash on hand. When the majority of buyers have already entered the market, there's just not enough buyers left. There's just not enough buyers left to continue driving the stock price up, so selling pressure has to come in because there's just not any more buyers left once you've drained all the buyers. This is one of the reasons contrarian investing is often a good way of looking at the market in market peaks, in overbought conditions, because what happens is you get into an overbought condition, you get into a market peak, and 85, 90, 95% of the market is suddenly bullish. Well, if 95% of the market's bullish, where did their money go? It went into the market. So if 95% of the available cash to invest has been invested, who's left to buy? There's no one left to buy. The only place for the market to go is down. That's a fundamental logic of a reversal that actually makes a whole lot of sense to me, and it is somewhat tied into price action. I'm probably making a complicated subject where I don't need to make one. But anyway, some of you followed it. If I confused you, just let it go. Just let it go, man. All right, so who's selling? Is everybody selling? They're closing their long positions. They're opening new short positions, and they're selling because the market believes the price is too high. There's also something that I refer to as a comfort aspect. I don't know that you're going to read a whole lot of books that are going to tell you that you got to pay attention to the comfort aspect. But the comfort aspect is a legitimate It's a legitimate indicator that unfortunately there's no indication for it. It's really a feeling. How many of you have ever gotten into a stock and you've traded it and you start to feel like this is too good to be true? Have you ever gotten into a stock, you traded it, and you thought this is too good to be true? And then you watch it one more day, it goes up a little bit, and you're thinking, oh, I'm going to pinch myself. This is really too good to be true. And the next day it all goes down, and you say, I knew it. It was too good to be true. That's the comfort aspect. Here's what happens. If you're feeling like it's too good to be true, you're feeling like it's gone too far, you're feeling like, my gosh, look at all the money that's on the table. How long can I ride this thing? You probably should be selling it because you're getting uncomfortable. And if you're getting uncomfortable, other traders are getting uncomfortable. I was very uncomfortable, and unfortunately, I was too uncomfortable. I was uncomfortable with the run-up that Apple did back in January, February of this past year. This current year, 2012. I was very uncomfortable with it, so I missed most of the move because I just didn't have the courage to jump in because I felt like, I don't care what the chart's telling me, it doesn't feel right. It felt like it was going to come crashing down, and much to my surprise, it went on for several months and many, many dollars beyond what I was willing to jump into, and it was disappointing in the end because I saw in hindsight what the trend was, but I still contend that I did the right thing by not trading it because I wasn't comfortable. I didn't believe that this trend should have been there. I didn't believe that it should have been trading that high, and so despite what my technicals told me, I just chose to not place those trades. And of course, in the end, I missed a great trade, but it still is a logical position to take. And the reality is when you're in a trade, that was a big example there, but in a small example like this one here, you jump in at 180, you ride it up to 240, that's a pretty good sized trade. And if you're a novice trader, you're pinching yourself saying, oh, this is too good to be true. If you're an experienced trader, you're pinching yourself and you're saying, hey, I just made a really good profit. And it's the experienced trader who listens to that intuitive comfort aspect and says, I think I'm going to go ahead and close this trade out, even though it's new territory, even though it's new highs. I don't know how long we can sustain at this rate. And that comfort level kicks in. That's part of the psychology that drives this selling pressure in what seemingly was no man's land. People would have thought, well, there's no reason to sell up here. Well, yeah, there is. If everybody's uncomfortable, they start selling. Same thing happens in a bearish trend as we get down to the bottom. Who's buying? Everybody. You've got people that are closing short positions. They're buying to close. You've got people that are opening new long positions. They're saying, hey, I see this opportunity. It's the second time I've gotten down to 180. I think next time it's really going to run again. This time it might outrun the 240, 250 range, so they're really excited about it. They're buying because they believe that the market price is low. They're looking at the history of the stock. They're saying, my gosh, 2 months ago, this thing was 240, 250. I don't know if it's going back to 240, but certainly 180 seems low. And so they talk themselves into it. They justify it. And again, they consider what I call that comfort aspect. There is an emotion that says, should it be here? And it's a lot of times it's a subconscious emotion where you say, I just don't know if I'm comfortable with this. Well, from a bullish side, people start to say, man, it's been going down, but this is too good to be true. I should be buying. And eventually you hit that tipping point. The herd kicks in, the buying pressure begins, and the whole cycle starts over again. Now, this is pretty interesting, isn't it? All right. So as we think through that, let's ask a deeper question. Understanding the psychology of why a trend begins. Understanding the psychology of how the trader is thinking. How do we explain a bullish trend that looks like this? Where you can sit here and you can practically draw a line that looks something like this, and it's pretty close. More importantly, how do you justify saying, well, buying pressure was at 180 here. By the way, this was the bounce out. This was the same stock. It was Amazon. I shut it off right here. Now I'm showing you the next trend where it went. Okay. So how do you explain that we bought here, we traded up, but the next time we had we had a higher low point. And then the next time we had a higher high point and a higher low point. How do we explain this trading behavior? And here's how the explanation comes in. Are you ready for this? As the stock moves higher, it pulls back and it retraces. Traders are still happy. Realize these traders that are buying at 190, they remember being at 240, watching it sell off to 180, and they remember the time before when it went from 180 back up to 240. So they're thinking, gosh, I don't know if it's going to get back to 180. I'm going to start buying. In other words, they are so optimistic that they jump in slightly early. They're saying, I don't even care if I get in at 180. I'll take it at 190. And that optimism, as the herd becomes that optimism creates a higher low point rather than a matched low point. Consequently, that herd buying pressure runs in. In this case, we had a big gap over earnings. After that happened, we had one more retracement in here. We get back down to 210. What are these traders thinking? Gosh, man, look at what happened. We recovered from that. We ran up into earnings there. We had a huge correction after earnings. We've sold off another $30. I think this thing's got room to run. And so they start buying in here way premature to where they had been buying before. Remember, just a few months before in March, they were buying down here at 180. Here we are in June, and they're saying, gosh, 180, I don't think I'm ever getting back down there. I'll take my chances at 210. And so they're willing to pay more for the stock. Stock runs up. The sellers come back in, drive it back down, but the buying pressure is so optimistic. They say, look at this. I'm almost back to 210. I think I'll do it at 205 this time. And you can see what happens. Now we've got a trend of behavior where the buying pressure is so strong that it's providing so much demand and so much support that we cannot even get back down to those previous price points where everybody thought it was a good deal at 180. The exact same thing happens in reverse in a bearish move. Take a look at this Netflix trade. So everybody's all excited because the stock has run from... on the chart, you see 175. It was much lower than that, all the way up to $300 a share. Everybody's super stoked about this stock, right? Then what happens? Some selling pressure comes in, and it came in fast. Now, when you see selling pressure that comes in this fast, we are set up for an all-out panic. Now, everybody wants one thing to happen. What does every trader want to happen? If you were holding Netflix at $300 a share, what were you wanting to happen? You were wanting the stock to come back up to 300 so you could get out at 300. But here's the thing about this trade, and you see this a lot of times with stocks that have run way up. For example, Netflix had a huge move. We went from in the double digits into the high triple digits, right, up to $300 a share. And a lot of these investors had purchased way back here. So if you're sitting on a trade that maybe you bought it at $100, and you held it all the way up to 300, when it came crashing down to 225, you're thinking, I sure wish I could get out at 300, But as you watch this thing run back up to 250, you say, that's good enough for me. I mean, I got in at 100. I got $150 profit. I don't know if it's going back to 300. I don't want to wait. I'll take it. It's good enough. And when you have a very, very overbought a stock that's run a long, long ways, a lot of times the selling correction is very, very fast because the traders have held it for a long time. They've got a lot of profit in it, and they don't care about eking out the profit like they did. When you've got a stock that has traded in a trading range a whole lot, what happens is the traders are trying to eke out every little bit of profit because a lot of them are, it's the difference in having a little profit and a no profit. But when you're dealing with a stock that's run way, way up, a lot of the traders have a lot of profit. They can provide that selling pressure without ever even retesting the original selling pressure that we had, in this case, all the way up here at $300 a share. And so in this particular case, the sellers came in and said, hey, I didn't get out at 300. I'm back up to 250. Get me out of this thing. Selling pressure came in. You see the panic starting to ensue. Buying pressure tries, but the sellers say, no, get me out. Now, who do you think this most recent one, the one the furthest on the right that I've got my arrow on, which traders are those? And I'll tell you, these are the traders that are selling because they did not sell over here at the first rally. These are the traders that were thinking it'll get back to 300. It didn't. Instead, before they knew what happened, it sold off rapidly to 200. Now that it's back close to 250, they say that's good enough. Get me the heck out of Dodge. What happens as soon as that happens? The sellers resume, and boom, we're off and running in a full-on panic. And if you saw the rest of this chart, you would know that in about 2 or 3 weeks from this chart here, it just fell like a rock and just tumbled. That was a full-on panic. What is a panic? A panic is when nobody wants to buy and everybody says, get me out, get me out, get me out, get me out. I got to sell, I got to sell. Now, here's the challenge. The reason that stocks run up so fast or sell off so fast is not because there's more buyers than sellers. It's because the market maker must match a buyer and a seller. And so what's happening in a selling frenzy is the market maker, we will abbreviate them MM, the market maker is dropping the ask price, trying to entice sellers. That's what's happening during a falling market. The market maker is dropping the price. I'm so sorry, I said that backwards. Dropping the price, trying to entice buyers in a falling market. In a rising market, the market maker is raising the prices, trying to entice sellers. And so we've got an imbalance of supply and demand, but in the actual price action, we don't. And that's why the price action of the stock is so telling to the technical trader. What the price action of the stock tells us is it tells us where the traders were willing to make a deal. We know that traders were willing to make a deal at 250. Buyers were willing to buy it up to 250, but that was the max because that's where the selling pressure resumed. And once the selling pressure resumed, it freaked out the buyers. And so as the selling pressure sold off, we know that buying pressure resumed around 210, but it wasn't long before the selling pressure came right back in just shy of 250. And we can look at a chart and we can say that's where those balances got out of whack. That's where they got imbalanced. We were not able to match markets there. Consequently, the price started to soar, or in this case, drop very, very quickly as the market makers were trying to literally make the market. Now, this is interesting, isn't it? Now, here's the interesting thing. Where do these support and resistance occur? And I've been calling them supply and demand. Hopefully you drew that connection. This is support and resistance. Supply and demand points are support and resistance points. Something we're going to call peak and trough in just a moment here. They're